Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Thursday, January 18th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day ahead. I do want to mention that today ends the most bullish historical period of the year. As I pointed out back in October, the close on October 27th through the close on January 18th is historically the best time of the year to be in the stock market. That goes back to 1950 on the S&P 500, 1971 on the NASDAQ, and 1987 on the Russell 2000. So this, at least from a historical perspective, kind of winds down the most bullish period. Doesn't mean that we don't have bullish periods throughout the rest of the year. We do, but this is the longest bullish period that we have throughout the year. And we say goodbye to that at the close today. So that will be one tailwind that's been helping the market for the last 2.5 months that we will no longer have going forward. So I have to look for other catalysts as well to take the market to the upside. I will say that this particular period, starting on October 28th at the open this year, or in 2023 through today, this has been one of the best periods dating back to 1950 on the S&P 500. I haven't done the calculation, but I would probably say it's in the top 5. I feel pretty comfortable with that. I think that the top one was 19%. And I know at one point we're up around 15 or 16%, but we've pulled back off the high. So I'm guessing we're probably somewhere in that, I don't know, maybe 13% area, maybe something along there, 14 maybe. Anyway, it has been a really good period, as history has told us it most likely would be. Never any guarantees. This marks, I believe, the 63rd time this period has gone higher out of 74 years since 1950. So it gives you a pretty good idea that the probabilities are strong that we're going to finish the fourth quarter on a positive note and even start the year on a positive note. Most of this strength, though, was during the early part of the period from October through the end of the year. January so far has been a little bit mixed. We've seen a little choppy action down, back up, down, and so forth. And we'll see how we finish the year. I did like yesterday's close. I liked the NASDAQ coming back, holding on to the 20-day EMA after being below it intraday. It looked like things were rolling over. And the NASDAQ came back nicely into the close. Futures are up. Let me give you those futures. So let's see. Why it's not coming up. Just give me one. Oh, here we go. All right. So right now we have the diamonds. Actually, things have turned a little bit because the diamonds now are down about 0.15%. Let's see about the others. The spider still up about 1/3 of 1%. And the NASDAQ, the QQQ, still holding on to solid gains, up 0.8 of 1%. That the QQQ closed at 407.21 yesterday, trading right now in pre-market at 410.43, back up not too far from the high. So really nice finish to yesterday's action, climbing back up above the 20-day, and then we saw, or now we're seeing a gap up potentially at today's open. The IWM actually finished strong yesterday as well, even though it was down about 0.7 on the day, and we'll go over some of the numbers here in just a second. But IWM is up about getting close to 0.5%, which is unusual. We haven't seen many gap ups in the IWM over the past couple of weeks, so this would be a welcome change. And after yesterday's hollow candle, and we're going to look at that IWM chart, but that was a fairly bullish channel after coming down and just about touching the top of a gap support zone in the mid 180s. So we'll take a look at that again in just a minute as well. Another stock I'm going to talk about later, I think it's kind of interesting, finished pretty good yesterday. It's been, in my opinion, manipulated to the downside. I'll give you my argument why. Tesla. Tesla is up over 1% today in pre-market. and it finished strong, and it's had a hollow candle the last couple of days, meaning that there's been some afternoon buying in the stock. Now we're seeing the gap up today, potentially an island reversal on Tesla. So again, we'll take a look at that chart today, and I'll explain a little bit about what I'm talking about with manipulation. You can agree with me, disagree with me. It's up to you. Yeah, I think that's probably about it. I do want to remind everyone, for those of you who've been, watching the show over the last several months, or maybe for a couple years, few years, whatever. Certainly appreciate that loyalty. To those of you that are new, glad you stopped by. Hopefully you like the show. If you do like the show, please make sure you hit the like button, and then also subscribe to our channel. That will help us with the YouTube algorithms, help us grow the channel, and to spread our reach. Love to do that. Really enjoy helping out the community, and I feel like we have a really good community here. Also, I want to talk about our model ETF portfolio. We actually today at 5:30 p.m. Eastern are going to be talking about the ETFs that have now been moved onto our strong ETF chart list, and from there we pick our model ETF portfolio. And I've actually got it, our EB ETF analyzer. It's an Excel spreadsheet. It's a really, really cool tool. And I'm going to show that a little bit later in the show as well. So I want to make sure you're aware of that. And yeah, so let's go ahead from there and let's get started on what's going on in the market. So today, what I thought I would do, let's just take a quick look at the major indices and what happened yesterday. Try and get through some of this a little bit quicker. But the Dow Jones yesterday did finish down about 1/4%. S&P a little more than 1/2%. NASDAQ down about 0.6%. But that really doesn't do it justice. I mean, if you see the NASDAQ here, you can see we went down early in the morning and then really just traded up, up, up. Had a little bit, this is just over the last 2 days, but we had a little bit of a downtrend line. So we wanted to respect that. But the gap up today, assuming it holds over the next 23 minutes, is going to take care of that little short-term downtrend. And the bigger picture, I'll show you in a minute, but that's the where you'll see the 20-day EMA holding is really nice support on the NASDAQ, actually the NASDAQ 100, which you can see down below, also down a little bit more than 0.5%. Small caps down just under 1%. But again, if we click on that, then take a look. A lot of that weakness was morning. We had a nice recovery, went down to a lower low, or maybe kind of like a double bottom there, retest. And then the final 2 hours, we saw some buying, and now we're getting a gap up this morning. So potentially, it looks like we're going to put in a higher high today, unless, again, futures reverse in the next 20 minutes or so. Looks like we'll put in a higher high on the small caps, which we haven't seen much of over the past couple of weeks. So this could be the catalyst to get the small cap area going again. But we'll have to, one afternoon, 2 hours, and then one potential gap up doesn't quite do it. Let's see if we get some follow through, but it isn't at least encouraging in the near term. Mid caps down a little bit less than the small caps, but more than the larger caps, falling about 0.7% yesterday. Let me go and pull up. I'll show you what happened in the sectors. So yesterday, in terms of sector strength, we had none of it, 11 sectors down, but many of them did battle back. You can see that at the end of the day, consumer staples had the best day, dropping just a little bit less than 0.1%. Down on the bottom, though, you can see it was pretty rough days in real estate, utilities, both down more than 1%. Real estate down almost 2%, 1.8%. Utilities down 1.5% almost. So kind of strange, but two defensive groups down at the bottom, and the other two defensive groups were first and nearly second. Consumer staples and healthcare both having pretty good days on a relative basis. I thought that was kind of odd, having four defensive groups, two of them leading and two of them lagging. Usually they tend to all kind of go together, either at the top, the bottom, maybe somewhere in the middle, but really strange to see them split like this yesterday. But what that meant was that on the selling that we did see yesterday, I mean, technology still holding in there. I mean, it's shocking to me, only because it's been so overbought. I mean, just you think with the market pulling back a little bit, technology, we'd see a little air coming out of that bubble. And I don't mean it bubble in a in a nasty or bearish sense. But we've been going up, and it's been leading to the upside. It seemed like maybe we'd get a little bit more profit taking when we see some selling in the overall indices. Not really seeing a whole lot in technology. Communication services, industrials, financials up here near the top. I still believe this could be a good year for financials as rates begin to come down. I think the inverted yield curve will flip, and that's going to help the banks. I mean, banks are probably the one industry group out of all of them that are impacted the hardest and directly from an inverted yield curve. So, and then it just depends on with banks whether or not they still continue to lend as to what kind of impact it has on the overall market. But so far, banks, even though they've been underperforming for a few years, hasn't really affected the overall economy. Or I shouldn't say that. It probably has affected it to some degree. It just hasn't affected it enough to throw the economy into a recession. I mean, there's still enough liquidity out there. And a lot of the companies that are driving the advance don't borrow. They don't really need the bank, not from a lending capacity. You're talking about the big, large cap names. Even, there's just a lot of companies in technology that have free cash flow, don't borrow. And so it's not too surprising that the issues we've had over the past few years really haven't impacted technology as much as some other areas. Anyway, that's some of my thoughts on that. But I do think that as rates start to come down, I don't think the 10-year Treasury yield comes down a lot. I think it's possible we go down into the 2s, but I'm thinking the 3 to 5 range, maybe 3 to 4.5 is probably going to be more of the range we see on the 10-year Treasury yield. But I do think the Fed will begin cutting aggressively the shorter term rates. And when that happens, we're going to flip that inversion, which will be good for stocks. Let's see. Let's move on and take a look at the 10-year Treasury yield. As far as economic reports go today, initial jobless claims today, 187,000, back below 200,000. We were expecting 206,000. Not good news for those of you who think that unemployment's going to go shooting up. I mean, initial jobless claims dropping. Also, housing starts and building permits came out. I know they both beat. Let me see if I can get you those numbers because I don't remember them exactly. This is for the month of December. Housing starts came in at 1.46 million units, and the estimate was 1.425. So a nice beat there. We did revise the November numbers down by probably as much as we beat this month. So maybe on a net basis, it's more of a wash. Permits, though, were raised from November. They actually revised that number higher. And the consensus number, which was almost 1.48 million units, actually came in at 1.495. So permits are not required throughout the country. Most areas, I think permits are required, but not everywhere. So if permits are going up, it doesn't really give you the whole picture because some areas don't even provide that information. But anytime I see permits going up, I think that's a really good sign because that gives you the intention to build. And why would you build? I mean, if you're worried about the economy, would you really be going out and getting more permits to build? Probably not. So I like it. I think that the numbers that came in today for the housing starts and permits were solid, better than expected. And I think that's another good thing. The only thing I worry about with housing stocks, as I've mentioned on many, many occasions, because I like to follow seasonality, is that housing stocks usually make their moves November, December, January. I mean, if you look it up on the seasonality tool at stock charts, go back 20 years. And I think those 3 months average going up something like 10.5, 11.5%, somewhere in there. The rest of the year is flat, might even be down a little bit. So 3 months basically carries home builders, and that goes back 20 years. That's not just what happened this year or the last 2 or 3 years or 3 of the last 5 years. We're going back 20 years. So basically almost the entire 21st century. Most of those gains are seen November through January. Of course, it's January 18th, so we're getting close to the end of January. I would be a little careful in that group as we, move on, only because history tells me so, and it's had such a big move. There's a lot of anticipation. I think the reason you see home construction do so well in the winter is because we're already anticipating what's going to happen in the spring. And when the spring actually comes, it's a sell on the news. Buy on the rumor, sell on the news. So I think the numbers and what's happened in home construction being the best industry group performer since the end of October, that it's really hard for me to think badly about the economy going forward when I look at this kind of a signal that the market is sending us. So anyway, keep that in mind as well. That doesn't mean we won't be choppy, and that we, again, short term, it's really hard to call the market. I'm talking about the big picture, which I still love. I think the stock market is not going back down. The stock market's going higher. From a longer term, intermediate to longer term perspective, I love the market here still on the long side. Short term, that's a little dicier. We got an election year, presidential election year. I've talked about all that. Won't get back into that again. But let's keep going. Let's move on to the well, actually 10-year Treasury yield. I never did really mention it, but it's 4.11, and we are seeing it up a little bit, about a 0.5 basis point today. I could see that 420 level coming into play still to the upside, but I really wouldn't be surprised to see this roll back over and trade in this range for a while. And that means probably multiple crosses of the 20-day EMA. We've already seen up above, down below, back up above. I think that could be more the norm as we consolidate. I think in the first quarter of this year, I wouldn't be surprised if we stayed in this 380, 378, whatever that was, up to about 420, 425 maybe, maybe even up to 430. That would kind of be stretching it. But that's the range that I'm looking for probably over the next couple months, 2-3 months. Next up, let's take a look at the S&P 500. So I pulled up this time the S&P on a weekly chart. So you'll notice this is weekly, going back 5 years instead of the daily chart I normally provide, just to take a little bit different perspective and look at things. We had that correction, which took us down below the 50-day moving average, took our PPO down to the center line. Everything's reset at that point. And off of that, we're now trending higher. I mean, we've definitely seen a little bit of maybe consolidation, maybe hesitation. I don't know exactly what you want to call it, which makes sense. I mean, we're at an all-time high, 4,800. This goes back to the all-time high right here at the beginning of 2022, before the cyclical bear market, and we're back up at that level. I mean, if you're talking about an area where it makes sense for the S&P 500 to pause, this would be it. And that's what we've been doing now over the last 3 or 4 weeks. We've been pausing, unable to break above that 4,800 level in any meaningful way, but also not falling apart. And my call to possibly go down to 4,550, 4,600 is all based on where that 20-week EMA is right now. Because anytime you're in an uptrend, a really strong uptrend, it's not unusual to test the 20-day moving average on the pullbacks. So here, I think, I think we could go back and maybe get a 4,600 test. I mean, the way this is shaping up looks a lot like 2019. I mean, here you can kind of see over the summer, early summer in this case, we went down, tested the 50, broke back out to a new high, and then look at these tests right around the 20-week moving average, and then we bounce and keep going higher. I kind of feel like that's what we're doing here. We moved up, summertime weakness to the 50-week moving average, then we rebounded to a new high, and now we're hesitating, and possibly we pull back to maybe 4,500 or 4,550 to 4,600. I'm going to say 46. I've thrown 4,550 out there. I think we got down to 4,600. That probably would be all we'd need. Maybe we get an intra-week move below the 20-week moving average. So maybe at 4,550 would come into play intra-week, something like that. But I do think by the end of the week, we probably close back over 4,600. That would be my most likely scenario on any short-term selling. NASDAQ 100, also looking at the weekly chart here. You can see we did break out above that November 2021 high. That was the all-time high for the NASDAQ 100. Not really a meaningful breakout at this point. I mean, here we got up to about 16.8 was probably our high. Actually, I can tell you exactly what the high was. 16,764. And the recent high was 17. Or no, what did I say? I said 17. That's 16. 16,764. And recently we had 16,969. 200 points, 1% above where we were back at the all-time high in November of 2021. So again, hesitation in this area makes sense to me. pulling back to the 20-week EMA could make sense to me. I have no problems with that. That, we don't. It's hard to predict when that's going to happen. I mean, again, you go back into 2021 or even 2020 when you're looking at these numbers. How do you know for sure that it's going to be February into March that we pull back? How about here from late April to early mid-May? How about in September? Well, September probably pretty likely, just because September is September, which is not a very good month. But it could happen at any time. I mean, here it happened in September again. Over here, it pulled back in September to the 20. I mean, so September is definitely something to keep in mind. We already know what happened in September here. I mean, we took a pretty big dip in September of 2023. So yeah, that's maybe something we could kind of look at as maybe more of the historical norm. But really, a lot of these pullbacks and tests, they're hard to quantify or to see necessarily ahead of time. Maybe we get a few clues, but it's kind of hard in the short term. Anyway, watch that rising 20-week EMA. That's what I'm trying to say here. IWM, now this one's on the daily chart that I still have, but I wanted to show you this gap down and the reversal there. And the low yesterday was 187.52. If we take a look at the highs, before we made this big breakout right here, the highs, 187.23, 187.06, 186.93, 186.97. So right around that 187 level were 4 highs before we made this big breakout. So the initial price support test is just above 187. We went from 205 down to 187.52. Now, I don't know if that's it or not, but I am encouraged by that hollow candle. Many times off the downtrend, you'll get a red hollow candle like that, where you gap down and then you come back up and close above. And if we get that gap up today, that then leaves this on an island as a potential island reversal. So, and if we keep going down, or maybe we move back into that range and sit down here for maybe we move into the 185, 186 area, maybe just below the 50-day, kind of consolidate in there and then gap up, that would be an island cluster reversal, where you have a number of candles that sit on an island. But right now, I mean, based on the futures, and again, let me take a quick look and let's get the futures there. IWM right now, just over 0.5%. So future staying strong. We got 8 minutes left before the opening bell. It looks like we're going to open up above 190, which then does leave this candlestick on an island. So it's possible that this was the reversal yesterday. We need to see follow through. I don't want to see another big move back down to 180 in the 187s today. That would kind of negate this and maybe treat it more as a cluster rather than just one candlestick. But if we gap up from here and start, this could be the start of the next uptrend. And I pointed out, I think it was in yesterday's show, a couple of different scenarios for the IWM, possibly a cup forming, or maybe an inverse head and shoulder. Left shoulder, this bounce back up right here to about 197 would be the neckline. Lower low prints the inverse head. This next move, if we could get all the way back up to that 197 level, would print the right side of a neckline. Then maybe a little pullback to about the 192, 193 area would print an inverse right shoulder. And then a breakout above 197 would be your trigger point for the pattern. So that's possible. I always like to look ahead and just, when I'm bullish, which I am, I start looking for patterns after we top. I look for a cup. I look for, maybe some kind of a bullish wedge. Anything that would suggest a continuation pattern. Because then when you start to get that reversal, in my opinion, you can get more confident, start to place trades, and then you kind of know what you're looking for in terms of the market continuing to fulfill that pattern, if you will. So that I think is pretty important. We'll see what happens. It's early. I know we could gap up and fizzle back. It happens. But let's see what happens today. If we gap up and keep going, that could be a really good sign. Transport's also on the daily chart, not really showing signs of a reversal. But what I would show is that on this chart, if we annotate right there, that was the resistance area. We've come back down, tested it here. We came back down yesterday, again, tested it. If we see a higher high today, reversing the pattern that we've had the past few days, that could mean that this is the key support level and that we're moving back to the upside. So watch that as we move forward. All right, chart of the day. I want to let you know, if you are new to Earnings Beats, come to our website. You can sign up for a free, no-cost 30-day trial. Check out our full service. It would be a great day to do it because we do have our model ETF portfolio event starting at 5:30 tonight, and that's for members only. But trial members are certainly welcome to come into any of our events. So make sure you get that started if you want to come in and check out how we're putting together the model ETF portfolio this year or this quarter. And if you go down, first of all, if you want our free newsletter, there it is. Name, email address, hit subscribe. No credit card required. You can unsubscribe at any time. But also over here, if you look at our historical performance, down here is our ETF portfolio. And this was as of yesterday's close. You can see that this quarter, we're up 12%. S&P 500 is up 10.78%. And when I say this quarter, I'm not talking about since December 31st. I'm talking about the quarters. Our quarter for our model ETF portfolio goes from the 19th of October through January 19th. The one that starts this quarter will start today or start tomorrow at the close, and it'll go through April 19th. So it's October 19th to January 19th, January 19th to April 19th, April 19th to July 19th, and so on and so forth. But anyway, you can see that we have outperformed. I think this is going to be the fourth quarter of the last 5 that we have seen outperformance. Most managers, portfolio managers, can't beat the S&P 500 over the course of a year. We're doing it by quarter now. We've really kind of had a pretty good streak going with this model ETF portfolio. So I'll talk about that in just a minute. But this is our results that we post daily on our website, or try to post daily. Let's go to our chart of the day. So I wanted to show you Tesla because I believe there's some manipulation taking place in Tesla. Just a couple things real quick. Bear with me. Agree with me if you want. Disagree. Completely up to you. It doesn't matter to me whether you disagree. First thing I've noticed on Tesla, since we topped back in July and been moving down, look at the AD line. This is the accumulation distribution line. It's been going up. Notice that when we came down and we broke recent support and moved to the downside during this move down, notice the AD line. Actually, I'll show you an up close chart here in just a second. We've moved higher on the AD line while the stock has been dropping precipitously. It looks horrible. I mean, if you own Tesla and it's in your account, I mean, there's no masking it. I mean, you got some serious losses from last week or two. This hasn't been a very good stock. But let's go on and take a look at what's happened intraday and throughout the day. This period where we broke down beneath this support level and it looks so horrible. Notice these big gaps and notice a couple of these hollow candles and notice how we're finishing off of the lows. We're not finishing at the low of the day. That happened at the top. That happened right here. But here coming down, it's been mostly gaps and early morning weakness followed by strength. And this right here is the proof, looking at the numbers. Since this high above 240 to yesterday's close at 215, we've been down roughly about $25 on Tesla. 21.5 of it is the net gaps. I mean, we're talking about 85, 86% of this move to the downside has been opening gaps. If that doesn't reek of manipulation, I don't know what does. From 9:30 to 11, we see a little bit more selling, probably folks getting scared. I mean, I'm getting all kinds of questions about Tesla. I happen to like Tesla a lot, and that's fine. You know, I can't call every stock every day in the market. I mean, obviously, that'd be a pretty tough task. But, you know, I'm looking at Tesla. I love Tesla, so I'm following it really closely. I'm seeing gaps, early morning selling. Look from 11 to 4 o'clock, 5 hours of every trading day, which is the majority of the trading day. Through this period, since we've dropped from 240 to 215, from 11 o'clock to 4 o'clock, we've lost 50 cents on Tesla. Does that look like a lot of distribution to you? Certainly doesn't to me. So I like Tesla going forward. Last thing I want to end with here is this ETF analyzer. I want to show you what we do. So as we approach draft day, which is the day when we put all of our ETFs into our portfolio that we're going to hold for the next 90 days, I go through, I do a lot of research. I mean, I'm looking at themes. I'm trying to figure out, okay, what's driving the market, those types of things. But after I go through all that, what I want to do is look at some of the best performing ETFs. So these are ETFs that have liquidity. I want to make sure that they trade enough shares. So all of these on here trade at least an average of 100,000 shares over the last, I think it's the last 60 days, maybe last 3 months or so. The scooter score is above, I believe I used 80. I might have been 75. So it's telling you these are some of the best scooters out there. I'm avoiding international. I'm avoiding ETFs. I'm not really looking for income. International, not looking for international, if I didn't say that already. It's basically just domestic stocks. And I look at each individual ETF, break it down by the various sectors so that you can see, what each ETF, how it invests from a sector perspective. Also, for every one of these, I have top 10 holdings, which if you come over, you can check out the top 10 holdings, each individual holding, the total. So you can see this is a very, very concentrated ETF. Top 10 holdings represents 99%. Now, this was back in October, by the way. This is not the one I'm going to be presenting tonight. So let me clarify that. This is as of October. But this is a very heavily concentrated ETF, very few stocks. So if you're looking for wide diversification, you need to be aware of this. Some people might think, oh, it's an ETF, it's widely diversified. Not all ETFs are created equal. So taking a look at different ETFs and what makes them up, if I have a couple of different ones I'm thinking about, I'll look at their individual holdings and say, oh, you got Microsoft. I like that. I like Broadcom. Google's good. Amazon. This is just a cash equivalent right there, by the way. Amazon's good. UNH just hit support. Okay. MasterCard's been strengthening with some of the financials. Abbott, I go down the list. There's Meta. Meta's been a strong stock. So I might say, oh, this is one that I really like. Whatever. But that is how I have a lot of research in front of me to make more informed decisions. And then what you can do with this is I can come back and I can decide, okay, that CGUS, I really like that one. I'm going to make that a core holding in my portfolio, 20%. And then I'm going to do here, I'm going to do 10%. And I'm just, throwing some numbers around now. I'm not even paying attention, but, another 15%. And then I'll throw 20% there and I'm done. Well, no, you're not, because we have a built-in audit feature here that tells you you've only come up with 80% so far. You still have to allocate 20 more percent. So then you go in, put 20% in there, and now you've got 100%. But this also tells you your results. You've got 40% of your money in technology, because we go through and do the calculation based on your allocation percentage and all of these numbers coming across, and we add it all together. So it's in formula. So you can say you got 40% in technology. At the time, the S&P 500 was only 27% invested in technology. So you're adding another 50% on. You're taking more risk by being in more technology, which maybe that's what you want to do. But I'm just saying that is something that you should be aware of when you put these ETFs together. I see so many people put ETFs together, and I've talked to many friends that have done this. I'm like, so how much technology do you own? And they're like, I don't know. I mean, I'm in a diversified ETF. I was like, well, do you know if you even own technology? I mean, what are your ETFs? They don't have a clue. They just went out, saw some ETFs. Maybe a friend told them, they bought them, filled out their portfolio. That's not any way to invest. I mean, you could have put together portfolios that had 80% in technology, which, by the way, would have been a great way to invest last few years, but not always. You go into a bear market, cyclical bear market, or secular, you're going to wish you didn't have 80% in technology. I can promise you that. But then, you can see what you own versus what the S&P has. And so it's really easy at the end of a quarter to say why you outperformed or you didn't. You can go back and look. You can say, well, it wasn't a great quarter for technology and I overweighted it. Bingo. That's probably going to hurt you. Anyway, I think this is a really cool tool. This 35% and all this was actually like back then, that was the number I was striving for. So I wanted to overweight technology a little bit, pretty much the same on discretionary. Industrials, I wanted to overweight. Industrials just had a really good period in the fourth quarter. And historically, that's what they do. So that was one of the reasons I wanted to up it. So you go through, you see your themes, you try to figure out what you want in terms of allocations, and then you pick your ETFs and see if they come in where you expect them to be. Anyway, that's about all I had for today. We're going to bring up the new ETF analyzer this afternoon, and I'm going to be going through that and talking about the themes in the market and what we're looking for over the next 3 months, along with the actual ETFs that we end up deciding to own for the next 3 months. So anyway, if you're interested in that, make sure you go over to EarningsBeats.com, start your 30-day trial. Again, this whole presentation usually takes between an hour and a half, and it'll start at 5:30 this afternoon, so probably done sometime between 6:37. But if you invest in ETFs, I swear, I think this is the best product anywhere. I haven't seen anything else like it. Really helps the individual investor put together a solid portfolio. But that's it. We're about 5 or 6 minutes in. I'm not going to switch the charts in again, but I will tell you the Dow right now is down 95. S&P is up 18. We've got the NASDAQ up 145 points. So that's up about 1 full percentage point on the NASDAQ so far, 5 minutes in. The small caps up about 0.5%. Same for the mid caps. And the VIX right now down 3%, back down to 1433. So that's where we start the day. Hopefully, I will see you later today, and we'll end the day with the model ETF portfolio draft and the ETF analyzer. So I will see everybody later today. Happy trading, everyone.